Strategic strength in the energy names beyond broad market reactions. These specific energy names are moving for precise and strategic reasons tied directly to geopolitical triggers and seasonal demand patterns. Let's start with the integrated oil giants: ExxonMobil, XOM, Chevron, CVX, and BP, BP. These companies benefit not just from rising crude prices, but from their global operational reach. They control the full oil chain, from upstream extraction to downstream refining and distribution. That means when the Middle East shakes, they don't scramble. They pivot, pulling crude from alternative global sources, protecting margins, and keeping product flowing where others stall. That's why they moved early in April. They had the insight and infrastructure to act before headlines caught up. Then we look at the refiners: Valero, VLO, Phillips 66, PSX, Marathon Petroleum, MPC, Delek, DK, and PBF Energy, PBF. These stocks are all about the crack spread, the profit margin between crude oil costs and refined gasoline or diesel prices. When international oil supply gets threatened, like during the Iran port explosion or nuclear negotiation jitters, crude prices rise, but refined fuel prices rise even faster. These companies are strategically located on the Gulf Coast and other major refining corridors. And in April, they capitalized fast. Then we have the retail refined edge. These companies don't just refine, they sell it at the pump. Think USO, the United States Oil Fund ETF. Not a company, but a real-time barometer of crude sentiment. When traders even sniff geopolitical tension, USO reacts instantly. It gives direct exposure to fear, to price spikes, to crude supply concerns, no middleman. That's why it led early in April. Finally, there's XLE, the Energy Select Sector SPDR ETF. It bundles all these names and rides the momentum of the entire sector. If the war risk grows, or even if talk of instability continues, XLE will likely expand on its April momentum. So this isn't random. These specific energy stocks are built to profit from exactly this type of Middle East tension. They've done it before, they're doing it now, and they're likely to do it again.
A quick reality check before we sign off. All charts and numbers you just saw come from publicly available data. Everything was crunched in-house. This content is for education and discussion, not a prompt to buy or sell. Markets carry real risk. Money can and does go south. I trade my own account and may be long, short, or flat any name we mention. Double check the facts and talk with a licensed pro before acting on anything here. Visit us at notesideasandthoughts.wordpress.com. See you in the next episode.